The era of a unified, momentum-driven UAE real estate market is over. In 2026, the performance of the Emirates has diverged into two completely distinct investment models. This divergence is structural. It is defined by a single metric: supply discipline. The way each emirate manages its development pipeline is now the primary factor shaping long-term pricing power. Abu Dhabi is maintaining a measured pace, delivering between 6,500 and 10,200 residential units. Dubai's pipeline will add over 120,000 new units. While demand remains high across both, the difference is how that demand interacts with incoming inventory, driving sustained value or gradual dilution. Investors now face a fundamental choice between a system of engineered scarcity and a system defined by massive liquidity. You can no longer rely on general market momentum to carry an investment. Protecting capital in 2026 requires selecting the specific supply model that matches your risk profile. Abu Dhabi's performance is built on a constrained pipeline. Housing stock will expand by only 3.3% this year, keeping supply aligned with market absorption. Limiting new units reduces internal competition, allowing sellers to retain negotiating power and ensure discounting pressure remains contained. Transaction data supports this model. During the first quarter of 2026, Abu Dhabi recorded 66 billion dirhams in transactions, a 160.7% increase year-on-year. This dynamic is most visible in prime locations like Yas Island and Saadiyat Island. In these districts, sustained demand and limited inventory have preserved a clear seller's market. This environment is driving a reallocation of capital. Investors are moving toward Abu Dhabi as a structurally defensive market where supply risk is easier to manage. By artificially constraining the pipeline, Abu Dhabi has created a low downside environment that prioritizes capital preservation over speculative volume. Dubai operates under a different structural reality. Its pipeline of over 120,000 units is designed for maximum scale and volume-driven growth. This high-volume approach is a return to Dubai's core model of liquidity and accessibility. It allows the emirate to attract a global range of residents, though it increases sensitivity to supply cycles. As these new units enter the market, the balance of power is shifting. Negotiating power is returning to buyers and tenants, forcing landlords to compete on more than just price. Broad-based price appreciation is slowing down. Market performance is now highly segmented, with returns dictated by build quality, developer credibility, and infrastructure proximity. In high-supply environments like Dubai Marina, investors can no longer rely on market timing. Success now depends on micro-market analysis and asset-level fundamentals. Dubai offers unmatched liquidity and scale, but its high supply model requires aggressive asset selection to prevent your returns from being diluted by the incoming inventory. In 2026, the definition of an attractive investment has shifted. Speculative capital appreciation is replaced by income durability as the primary metric for success. We see this income stability in Abu Dhabi micromarkets. Al Ghadir is delivering yields over 10%, while Masdar City is nearing 9.8%. These yields are anchored by technology professionals and airport personnel who provide a consistent tenant base. Proximity to economic hubs is equally decisive in Dubai. Property prices in Dubai South spiked 107%. The impact of these projects follows a predictable pattern. Assets near planned infrastructure typically see a 5 to 15% price increase upon announcement, followed by an additional 10 to 20% as construction reaches completion. This pattern is currently driving premiums for properties located near the Metro Blue Line and the new Etihad rail stations. When buying in a high supply cycle, tying an asset to logistical or transit infrastructure is the only reliable way to guarantee a long-term valuation floor. The divide between Abu Dhabi and Dubai is a sign of market maturity. The era of casually buying anywhere in the UAE and expecting a profit has ended. This chart outlines the 2026 investment matrix. Your decision depends entirely on your primary financial objective. Conservative investors should focus on Path A. This is the route for those who prioritize capital preservation, low downside risk, and predictable income. Abu Dhabi is the choice for this segment. Its engineered scarcity protects landlord leverage and ensures high occupancy rates. Path B is for growth opportunists. This model is for investors who require high transaction volume, scale, and ease of entry and exit. Dubai remains the engine for this segment, provided you use micro-market selectivity to identify assets that can maintain demand despite increased competition. To succeed in 2026, you must look past general market narratives. Your returns are dictated entirely by the discipline of the supply pipeline surrounding your specific asset.